Concern about the global credit markets, though, do continue to weigh not only on debt but also U.S. stocks. What will it take for the financial markets to regain some confidence? Doug Sandler is Chief Equity Officer at Riverfront Investment Group. He joins us now from Richmond with his perspective on the markets. Welcome to you, Doug.
Good afternoon.
So investors are a little more risk averse today on that news out of Greece, and Moody's looking at the U.S. and the U.K. a little more closely. Is that just an excuse perhaps to do some profit taking, or do you think there's some real meat in that there's some concern that maybe our risk positions have been too bold of late?
Yeah, I think I'd go with your former, which is it's an excuse for profit taking. And I think if you look under the surface, things aren't as bad as what the S&P may indicate. You end up looking at stuff like technology, some of the healthcare spaces, and some of those areas. Things are pretty good. Downside's been left by or led by the energy and materials group. Sort of the lower quality areas of the S&P, and I think that should be expected. I think the market's simply evolving from what was a credit rebound, where stuff that was impacted by not having credit, they've got that extra shot of air to go a little bit longer, and we're evolving into what we call a profitability rebound, which means the kind of companies that are going to actually produce the numbers will be the companies that start to lead going forward, and things will start to make a lot more sense in our opinion.
Okay, and you moved, since you're talking specific industries, financials, to underweight. Why is that? Especially with all these banks coming out repaying their TARP.
I think the move we did 2 weeks ago, which was underweighting banks and overweighting healthcare, really underscores this view, which is if I look at financials, we kind of got dragged into them on a risk management basis. It was difficult to really feel like the fundamentals were better for financials, but ultimately we didn't know when the bounce would stop because they were really cheap, going out of business cheap, and they were going to bounce back to at some point, which was going to be a cheaper value than they were a few years ago, but we didn't know where. So we got dragged into them, market weighted, which we need to do when the market's telling you that you're wrong with your fundamental view. But lately what we saw is that their leadership that they had, that's been passed on. And I think some of the real long-term secular problems for the financial industry are coming back, which is more regulations. It's going to be less leverage, and it's going to be some of their most profitable businesses they've exited. So you basically have a financial industry that I think is a lot less earnings engine than it used to.
And Doug, my fixed income guy, George Goncalves, has stuck around here. So let me get you to pipe in, George. Do you think that this is reallocation of assets here with the gains in bonds as people pull out of stocks today?
I think that you're still seeing this shadow asset allocation that's been happening for quite some time, and it's also, in my opinion, a shadow way of playing the dollar. And I think that if you're going to be moving to buy a U.S. asset, you're going to do it in the bond market first before you do out the curve. So I think out the risk spectrum curve. How
much of the stronger dollar, Doug, is playing into the sell-off in stocks today?
Well, certainly what's affecting energy and materials more than anything, and you can see that playing out. Our view, though, is the dollar's finding a bottom. I think that bottom's probably temporary, and the trend in the dollar is secularly down. And I think we just got to plan for that in our portfolios as the Fed continues to print money, and that printing money machine is accelerating.
Stocks versus bonds, generally, a couple seconds. Quickly, what should that allocation look like percentage-wise?
Well, from our perspective, we are underweighting stocks across all our models. The only question we as stock investors, we say lots of good deals that we can find. Our fixed income counterparts are saying it's pretty difficult to find good buys right now.
And George, last comment, stocks versus bonds.
Sure. I think that in the interim, I think you have to move more towards cash and bonds, and I think that's the place to be.
All right, gentlemen, appreciate your insights. Thanks for joining us today.